Welcome to another episode of Aliyah Money Talks, brought to you by Blue and White Finance. Today, we're going to be doing something a bit different. In our efforts to build out resources for Olim from all over the world, today we're going to have a discussion focused specifically on financial and investment planning for Olim from the UK, for Olim before and after Aliyah, British Olim. If you're not British, please pass this on to your British friends who are planning Aliyah, who have already made Aliyah. We think they will find a lot of value in this conversation. With that, I'm excited to introduce today's guest, Joshua Pomerantz. Joshua is an independent financial advisor at
Hello.
Vintage Wealth Management and a recently licensed investment advisor here in Israel. Josh, why don't you get us started? Tell us a little bit about yourself, your Aliyah journey, and about your work.
Yeah, great. Thank you. It's lovely to be here. Excited to be a guest on the podcast. I've been watching with excitement the stuff that you guys are doing. So it's exciting to be a small part of it. So I made Aliyah end of 2016, 6 years ago, 6 and a bit years ago with my wife, and then first child, daughter, just about 2 years old. We now have 2 more children. That daughter is now 8. We've got a 5-year-old and a 3-year-old. And I actually started my journey as a financial advisor then. Interestingly, I made possibly the worst commuting decision of my life. I started my role as a UK financial advisor pretty much 3 days after we made Aliyah, working with Vintage Wealth Management based in England, and spent the next 2.5, 3 years traveling back and forth and getting my qualifications and ultimately building up a client book of advice where I'm assisting people in their financial needs. The way that I explain it generally to people is our role as a financial advisor is like a GP, a family doctor. Anything that has a financial impact on your life is something that we can generally assist with. But there are times where we may need to bring in an expert, and something like cross-border issues is certainly a place where there are specified needs. I think just quickly before we jump into the nitty-gritty, first of all, if I have any, I think it's okay because it's focused on Anglo or UK-based Olim or potential Olim. But if I have any language barriers from England that may not translate, then just let me know. But I should say anything that we say here today obviously doesn't constitute advice, and certainly every different case is individual, and you certainly need to seek advice on your own individual needs and cases. But we'll try and give as much general knowledge as we can. My compliance would tell me off if I didn't say that.
Yeah, no, that's perfect. I think this is this is for general education purposes only. This is actually a topic I don't know much about, so I'm really excited to learn. I'm looking forward to learning more from you today on all of this. Let's jump in with the question about, somebody who's Aliyah planning, they recently made Aliyah, they're thinking about selling their UK-based assets and bringing it here to Israel as part of this process. What time constraints should they be thinking about with that? Is there any kind of tips you have and suggestions around planning for that?
Okay, so it definitely depends on what type of asset we're talking about. I'm going to split it into 2 types of assets. One is property and one is everything else. The reason being, with everything else, so whether it's stocks and shares, or physical jewelry or anything else, literally, which isn't property. When you become a non-UK resident, which I know we're going to come on to later, at that point in time, if you then sell those assets and don't return to the UK within 5 years, there is no CGT, there's no capital gains tax.
Yes.
So generally, when you sell an asset in the UK, if you've made a profit after a certain amount, there'll be a capital gains tax to pay. But if you sell it when you are not a UK resident, you don't pay that CGT, don't pay that capital gains. So certainly, for someone who is planning on leaving the UK indefinitely, it makes sense to hold on to them should they be able to, at least until they're qualified as a non-UK resident.
And
That's
also with
assets.
yeah, also within the 10-year tax holiday,
Go
I
on.
assume that's kind of a relevant factor here as well.
Right, so exactly. So that's the UK side, and on the Israel side, yeah, exactly as you mentioned. Obviously, one of the most well-known benefits of making aliyah, besides moving to the land of Israel, is obviously from a financial perspective, there's a 10-year overseas passive income tax relief, and it's important to highlight the passive income element because some people don't realize that actually, if you're earning overseas in your physical monthly
Israel, right.
wages is an overseas income, you don't get that benefit. But any selling of assets exactly would qualify for that tax exemption in the first 10 years. So that's when it comes to anything other than property. Why did I separate out property? So property doesn't fall under that CGT exemption, and you do need to pay CGT on property. There are 2 points to note about selling property. The first is if it's not your main residence in the UK, if it wasn't your only home, and you had if it's a rental property, an investment property, then there'll be capital gains to pay. Depending on when you bought the property and when you sell the property, there may be some element of revaluation to 2015, but I think that's a bit in depth for where we are now. The rules changed basically, and sometimes you can revalue it, but bottom line, there'll be CGT, there'll be capital gains to pay. When it comes to your main residence, there is something called primary or principal property relief, where actually you don't pay capital gains tax on your main residence.
At all,
that
or up
has
to a
a
certain
time
threshold?
limit on it. At all. So in the UK, at all, if you moving properties, you don't pay capital gains tax. However, if you leave your main residence, so for example, you make aliyah, maybe you decide to rent out your main residence for a period of time until you find somewhere that you're ready to settle in Israel and buy a property. There is a time limit on that capital gains exemption, which used to be 18 months. It's now, I believe, 9 months. The other thing I should have mentioned at the beginning is obviously everything I say is as our understanding of the rules at the time. Things change regularly. So there's definitely something to think about there when it comes to when you sell your main residence. It's not a cliff edge. It's not a cliff. You don't sort of end up paying full capital gains tax after the end of the time period straight away. It is sort of, you are given a relief for the time period that it was your main residence, but it's definitely something to think about whether you want to sell it within that time period to receive full capital gains. Bottom line, on a one-liner, I would say both property or assets is best to sell once you've already made aliyah, but with property, to be aware that you're certainly in a rental property going to be paying capital gains tax, and then your main residence will likely pay some if you don't sell it within the first 9 months.
Great. Okay, perfect. So let's pivot a little bit and talk about an issue that I think is on a lot of people's minds, and that's currency risk. I mean, if you look at the sterling relative to the shekel over the last 20 years, it's basically halved. About in terms of its value, and it's a brutal chart to look at. How do people preparing for aliyah, how do people who've already made aliyah with UK-based assets, how do they think about currency risk? How do they maybe take steps to reduce that risk in the future? What are some tips that you might have around that? Obviously, it's a very broad topic, but
yeah, absolutely. I think the first thing to point out, which I think that a lot of people don't necessarily realize, I think myself would be included in that picture, because it's sort of, a behavioral thing. A lot of people from the UK will think back to the times when it was 8 shekels to the pound, or even 6 or 7 shekels to the pound, and are looking at the shekel sterling rate now at today is what we may consider high over the past year. It's about 4.28, and think that times are terrible. But I think what's really important to note is that back in September last year, 2021 was when the exchange rate really took a very big downward dive. Slowly it's been creeping up, but that's when it really took a one big dive since Brexit in 2017, I think, if I remember correctly, where it took a bit of a dip. But so at that time, I actually did a bit of research on the historic exchange rate between the sterling and shekels, and I don't know whether it's interesting, difficult, I don't know what the phrase would be, but what I think is noteworthy is actually the average exchange rate over about a 34-year period, about when Israel became what we might call a developed economy with a serious exchange rate in the world. The average exchange rate is actually about 4.55. So I think for a lot of people, remembering the times when it was 7, 8 is difficult. But if we look over the history, actually probably where we are now is a more realistic and true rate, especially when looking at the current situation of both economies. Taking out, I know this is going out in a few days or a week's time. We don't know what's going to happen with any judicial reforms. Taking out the immediate current political turmoil in Israel, the Israeli economy is one of the strongest economies in the world for good reason. It's not abnormal. There's lots of things going on in the economy that makes sense for that to be the case. And the British economy also, for good reason, is struggling slightly. So I think that we're slightly under the average. Does make sense. And at the moment, that hasn't answered your question just yet. So let me jump onto your question now of what you can do about it. I think the first thing to note is no one can ever guess an exchange rate. Oh, yeah. Much more than investments where you have analysis and can look at things, and obviously no one can predict the future. Exchange rate is a bit more closer to gambling. But I think the most important thing is the way I view it is there's 3 areas that I view. The first is if you're planning on living in Israel for the rest of your life, however long that may be, whether you're younger or older when you make aliyah, your center of life, your financial center of life is going to be in shekels, and therefore you should hold an asset base in shekels. So that's what you're going to be spending in. For me, the way I view it when bringing money over is, did the exchange rate give you what you need? And if the answer is yes, then could you have got a bit more yesterday, a bit more tomorrow? Maybe. But my view is, did it give you what you need? And if the answer is yes, then you should be comfortable and happy with that. And I think it's really down to a case of bringing in the money probably as quickly as possible when you make aliyah, and taking that stock and starting afresh and not looking back at the exchange rate at what once was yesterday or tomorrow. Having said all of that, I do find with a lot of clients who are thinking about making aliyah, they're nervous about the Israeli financial system. It's not as secure as the UK, certainly. There are horror stories of people who don't pay their car mechanic for a week or a month or whatever, and suddenly find that all of their assets are frozen and they can't access their bank account and their credit card is locked. And so people are nervous about that. And I think there is a truth to that point to an extent. And therefore, I guess, as with anything, it makes sense to always have diversification. Don't have all of your, if you like, don't have all of your eggs in one basket or all of your pounds in one shekel, I guess.
Yeah, for sure. Yeah, and I think it definitely makes sense for a lot of Olim to maintain some investments outside of their country, not just for UK Olim, but for Olim from all over the place, while still understanding this currency risk and understanding that keeping an asset base, keeping savings in shekels can really bring a lot of value. What I want to do now is kind of pivot and talk a little bit about... I think
the other thing quickly on that point is... Yeah. Oh, sorry, go on. No, okay.
No,
Just
please,
one
please.
final point
Yeah.
is, I think another thing that I always find with people discussing with me is actually, however long people have lived here, sterling is still, for UK or Lim, I assume it'd be the same for other countries, is a currency they understand. And certainly for people from America and England, sterling and dollars are hard currencies used worldwide. And whilst for us in this country, shekel is obviously the main picture.
Currency.
Internationally, it's not what we would consider a hard currency. And so there it definitely does remain importance to hold a mixed portfolio.
Yeah, for sure. So I wanted to focus now a bit on some of the investment account, retirement accounts out there and talk about some of the ramifications. Obviously, again, very broad topics, but start touching on some of these issues for Olim that are making aliyah with these assets or thinking what to do with these assets. Let's start with a UK state pension, right? Can Olim continue to contribute to a UK state pension? How can they claim it in the future? Tell me a bit about that.
Okay. Simple answers to both of those questions are yes and yes. You can continue to contribute and you can claim it in the future. Again, under current legislation. Contributing to the state pension when you leave the UK depends on your status before you left the UK. There are generally two what we would call voluntary contributions. One of them is quite expensive, and one of them is actually very affordable for most people. I think it's about 80 or 90 pounds sterling a year, if I'm not mistaken.
Okay.
It depends. Essentially, if you were in full-time employment or employment where you were paying what we would call national insurance or social security contributions prior to making aliyah, you're almost certainly going to be able to make those lower contributions, voluntary contributions. It definitely, as I said at the beginning, everything's an individual situation.
Yeah,
and sure. I'm not giving any advice, and everyone needs to seek their own personal advice when making any decisions themselves. It's almost never not sensible to not contribute, i.e. it's almost always sensible to continue to contribute to your UK state pension, especially if you're at certainly if you're at the lower rates, which most people I believe would be. The reason being, there is something in the UK called triple lock. The level of the state pension in the UK is not terribly high. It's not going to help support someone's full retirement, but it is a significant amount. At the moment, it's about £9,000, £10,000 a year. And there in the UK there's something called the triple lock, and what that means is, no matter what, every single year there will be an increase in once you qualify for state pension, once you withdraw the pension, there will be an increase in your state pension, and that increase will be one of three things: either 2.5%, or an average wage growth in the UK, obviously between May and July. In the previous 3 years, average of the previous 3 years, or the level of inflation, which I think, as we're currently recording this podcast, is something that a lot of people will understand in seeing the past year that we've had and how it's become the forefront of everyone's knowledge. So, for example, at the moment, or the last time that the state pension was increased, it was increased by 10.1%, which was what inflation was at the time. In the UK, which is a significant increase in pension income. That may change, but at the moment, that triple lock is something which is really, really beneficial to the UK state pension. And you continue to get those increases whilst claiming the state pension in Israel. There are certain countries that you don't get that. And I should say that I have heard, I've not seen in practice, but I have, meaning I've not seen either way in practice, positive or negative, but I have heard that in certain areas of Israel, that triple lock increase does not apply.
Interesting.
In the disputed territories.
Interesting. They treat it differently.
Yeah. So again, I haven't seen it where it has applied or where it hasn't applied, but I have heard that is there. So that's something to note. But yeah, if you are able to make voluntary contributions, it's definitely worthwhile. It's, there's a certain increase in your investments by that triple lock. If you think about your money going into the pension as an investment. And currently, the state pension age is 67, which is when you can start to claim the pension. That's likely to increase with time.
Increase, yeah. Great. So, what are QROPs, and can this provision help Olim in any way? So that's something I saw a little bit about when I was doing research for this. Yeah.
Yes. Okay. Fine. Probably best to step back a tiny bit before we talk about what's called a QROPs. In the UK, you have, like the rest of the world, you've got pension savings. Unlike a lot of other countries in the world, the pension savings in the UK at the moment are pretty flexible, both in terms of how you can invest in your pension within your pension, and also how you can actually access your pension at the time of access. In Israel, for example, it's quite limiting on how you're able to withdraw money from your pension. It's pretty much what we would call a lifetime annuity, an income paid for the rest of your life based on how much you've saved. In the UK, pensions work, without going into too much depth, pretty much like a bank account. You're able to withdraw as and when you need, at any level that you need. Okay, that's the starting point. QROTs were created for people leaving the UK, retiring abroad, looking to take their retirement benefits out of the UK into, or to be able to take them into the country that they are retiring into. A QROPS is what is called the acronym is Qualified Recognized Overseas Pension Scheme. So it has to be a company that's recognized by the HMRC, and generally they're in a third country. So you've got the UK, the country you're retiring in, and there'll be a third country with very strong, i.e. good tax benefits, where that QROPS will be located. And usually they'll have a double taxation treaty between the UK, that country, and wherever you're retiring to. And the idea behind them is, as I said, is allow you to take your pension benefits out of the UK, retain the pension wrapper and the rules of a UK pension, but access them in the country you're retiring into. Are they beneficial for UK Olim, so UK retirees or non-retirees moving to Israel? Previously, the answer would have been yes. Something to note is lots of people hear about bad stories about QROPs, people losing money and people being tricked into moving into a QROPs. What I should say is a QROPs is just something that wraps the money in that pension sort of hold. Whatever goes inside, whatever investments you hold, can be anything.
It's up to you.
It's not the QROPs itself that is the problem. I would say that in those situations, it was the advisor. So previously it would have been very beneficial for a UK aliyah to use a QROPs for their pension savings. However, a few years ago, 2018, I believe, the UK changed the rules with the QROPs, and there's actually now a 25% tax charge if you move your QROPs, if you move into a QROP, if you're moving out of Europe. So generally, it doesn't make sense anymore for someone making aliyah, especially because also I think in about 2020, could be 2019, the tax treaty between Israel and the UK was updated, that actually you can now essentially choose where you want any UK pension savings to be taxed, whether you want it to be taxed in England or in Israel. So, for example, someone in their first 10 years starting to draw on a UK pension, it's very beneficial to choose for it to be taxed in the UK.
Got it.
So certainly, QROPS is not so desirable anymore for an aliyah.
Relevant. Okay, great. So how about, I was reading about SIPs, about ISAs. How should Olim be preparing, if you're making aliyah with these type of accounts? Break it down for us, explain a little bit what they are and kind of how we should approach them when we're making aliyah with these accounts.
Okay, so a SIP, it will be a very simple answer to a very simple question to answer. A SIP is a self-invested personal pension. So that's pretty much what almost all pensions are now in the UK. And if you're making aliyah, almost certainly you don't need to touch it. You don't need to worry about it.
Keep it.
Again, certainly you can't withdraw the money. You're not unless you're over pensionable age. You're not allowed to. And again, it will come down to that question of QROPS or not QROPS, and almost certainly makes better sense to leave it in the UK and continue for it to be invested until you're such time that you need to draw on it. You can't, by the way, so I do get questions every now and again, both ways, UK to Israel and Israel to UK, whether you can transfer pension assets from one to the other. So, for example, if you have a pension in the UK, can you bring it into your Israeli pension with Maytab or whoever your pension is? And the answer to that is no, or at least the last time we checked. Okay. So with a pension, again, not personal advice being given, but almost certainly it makes sense to leave it where it is and continue for it to be invested accordingly. An ISA is something different. An ISA, the most comparable wrapper product in Israel would probably be a Keren Hishtamut. It's a savings account with specific tax benefits. And the tax benefits on an ISA are that you don't pay capital gains tax on any money after it goes in. There's a limit you can save into it each year, but you can save into it each year up to that limit. And that tax saving happens immediately, unlike a Keren Hishtamut, which is a 6-year wait. So what can you do with your ISA if you make aliyah? Again, you don't have to do anything. You can retain the ISA in the UK if you wanted to. It can remain invested. I should say you can have what's called a stocks and shares ISA, so you can invest the money in the ISA. And it can continue to grow until you need it, and you can withdraw it. The only limitation you have as an aliyah is you're not going to pay capital gains tax when you sell the assets in any case. So you don't retain that tax benefit. But there's no downside to retaining an ISA from an investment perspective. Obviously, there are other areas where it may impact retaining an ISA in the UK. For example, residency, domicility, which I think we're going to come on to shortly. But there's no reason to sell your ISA if you don't need the funds. The only thing to note is you obviously can't contribute anymore once you're no longer UK resident.
Good. So let's talk about that specific issue. I know it's a bit of more of a tax question, and it's a little bit complex, but let's just I guess touch on it a little bit. How maybe there's some tips that you have come across in terms of breaking your UK tax residency, breaking your UK domicile. What are some of the tips that you can suggest to that? Because that seems pretty valuable for somebody who's making aliyah to start thinking about doing.
Yeah. Okay. So there's two questions there really. The first is tax residency, and the second is domicility. So for those that don't know, they're not the same thing. I think everyone can understand. And by the way, residency is also not necessarily the same thing as tax residency, but I think for this purpose, we'll keep it the same. For those that don't know, tax residency is essentially, do you have to pay tax in this country? Let's keep that as simple as we can. Domicility is not the same. You could very easily be non-UK resident, non-UK tax resident, but retain what's called a UK domicile which would have implications, which I'll come on to. Let's start with tax residency, as I think that's the easier one to deal with. Pretty much, there are a number of tests, depending which category you look at. There's two main categories of tests. And if you meet those criteria, you are going to be tax resident in the UK. And for an aliyah, there's less of an issue being a tax resident in the UK because there's a double taxation treaty. So generally, if you're dealing with your taxes in Israel, it's not going to impact anything in the UK. But it's essentially, have you spent more than 183 days in the UK in the current tax year? If the answer to that question is yes, you are a UK resident. Doesn't matter, whatever you do the rest of the time, you're UK resident. Another test is, do you own a property, or have you owned a property that you are the only one to have access to? So a rental property could fit into that remit, although it might not. For more than 91 days in a tax year. Within that tax year, have you spent more than 30 days in that property? If you meet that rule, yes, you're a UK resident. And have you worked full-time in the UK for a 365-day period? Doesn't have to be a year, but for a 365-day period, and some of those days in the tax year that you're looking at. So obviously in the UK, the tax year runs from April to April. So if you meet any of those tests, you're immediately a UK resident, UK tax resident. If you don't meet those tests, there are some other tests. If you may be called an overseas resident, and that's, do you work full-time outside the UK, but you've spent more than 91 days in the UK, and out of those 91 days, you spent 30 days working? If that's true, you're a UK tax resident. Or if you've spent fewer than 16 days in the UK in one tax year, or 46 days if you've not been a UK resident for 3 years, then you don't need to worry. So if you spend more than those number of days, then you'll be a tax resident in the UK. What's really important to say about this is, well, I said at the beginning, we're like a GP, a family doctor. Something like this, getting a full opinion on tax residency, and certainly the next one when we talk about domicility, is not something that your UK financial advisor will give you. It's an accountant's question, and specifically a tax accountant's question, tax expert question, which obviously is something we'll assist with, and we have in the UK, for example, got connections with people who will be able to assist with that. But it's not something that we would do as an IFA. So that's tax residency. And what does that mean? It means if you have an income in the UK, say for example you're renting out your property, if you're retaining it for a period of time, that will be liable to UK tax. Again, doesn't mean you're going to pay tax on it in Israel, because there's that double taxation treaty, but it does mean you need to deal with any income that's arising within the UK. Okay, now's the big question. Domicility.
The harder one.
Right. The harder one. So if you don't meet any of those other tests, but you do meet some of these, you may be what's called deemed domicile for tax reasons. There's another rule, which I'm going to come on to in a moment, which isn't the same. But there are a number of ties. It's whether you've got a family tie. So, the first one is obviously the days, which is what I've already said. That's the similar tie to the previous tests. Is, do you have a family tie in the UK? So do you have parents or siblings that you've got they've got property that you could stay with, and you do stay with them for a number of nights in the year? I think it's about 16. Do you work in the UK have you worked for more than 3 days in the UK over a period of 40 days? And have you spent more than 90 days in the UK over a period of 2 tax years? And the last one, I believe, is the UK the country that you've been in when at midnight the most throughout the year? If that makes sense. So there's a lot of tests. So that's
What
why
a
you really
tax
need
code.
to, it's not,
Yeah.
yeah, exactly. So it's something you really need to take full advice on, because there'll be other certain things where, someone who this is what they do will be able to understand your situation in a lot more depth and really give you a full opinion. Do you meet any domicile rules? Everything that we've said is to do with tax, mainly income tax, but tax and residency. Those domicile rules are really important. And the first point you made is how does an aliyah cut their ties to the UK? Simply, the easiest way to do it is, if you're not planning on going back, cut everything that you have. Shul membership, gym membership if you're keeping it for whatever reason, any clubs that you have in the UK. One that I find regularly is government party membership. Things that tie you to the UK, even though you're not there anymore. They might be nostalgic, but cut them out.
Cut them.
Then there's one other domicile rule, which specifically is mainly used when it comes to something called inheritance tax. Inheritance tax is a UK tax, and put simply, it's a tax on someone's estate if it's over a certain level after they die. Okay. It's a hefty tax, by the way. If you're above that level, it's 40%. So it's pretty hefty, and for most people, it's on income or assets that have already been taxed elsewhere during their lifetime. So it's really something that, if you can avoid, is something that you want to be able to avoid in a legal, kosher way, and not avoiding tax way.
Of course.
And when it comes to inheritance tax, if you are non-domicile, residency isn't so relevant to UK inheritance tax. It's about domicility. If you are non-domicile, only your UK situs assets, that's what they call it, would be taxed for inheritance tax. So, for example, if you retained your ISA, a SIP, a pension, doesn't count, but if you retained your ISA, or if you retained a property, or whatever it is, anything that's physically located in the UK would be taxed for those purposes. Otherwise, anything else is not. If you are deemed domicile, and this is where it becomes really important for an aliyah, your worldwide assets are then taxed for IHT, for inheritance tax. So it could be you've made aliyah, you cut all your ties to the UK, you think you've cut all your ties to the UK, but actually you haven't, and therefore for a period of time you've been considered domicile in the UK, and suddenly you've got no assets in the UK. God forbid you pass away, and your estate, your full estate, wherever you've moved it to, is now liable to inheritance tax because you haven't cut your ties well enough. So if you don't cut those ties that we mentioned before, and certainly if you're not sure, if you haven't taken the advice of how to do it properly, then for inheritance tax, if you're what's called deemed domicile in the UK for 15 years out of the last 20, you'll be considered domicile for inheritance tax purposes. So it's definitely something that's, certainly if for a lot of our older clients who are looking to retire in Israel, have built up an asset base, have a large estate, it's something that definitely needs planning. And as you can hear from the way that we've been talking about it, it's a complicated area.
Yeah, I hope a lot of Olim don't come away from this discussion and say, forget the UK, forget Israel, I just want to move somewhere with a simple tax code. Chances are you're probably not going to find anywhere with a simple tax code.
Yeah,
but
exactly.
Beyond
Absolutely.
that, you can get help with these issues. You can do proper planning, and really,
I think
with the proper planning, you can make a very big difference.
Exactly. I think that's really the most important thing to say is as part of, the whole reason behind this podcast is to give people the information. But obviously, as with anything in life, there are people who deal with this day in, day out, who are the experts in these areas and are able to assist. And inheritance tax, specifically is something that I come across on an almost daily basis now, and is really in the UK, the only optional tax. With careful planning, if you start early enough, is very easy to plan for. And when it comes to leaving the UK and making sure that you're not domiciled in the UK and liable to inheritance tax, it is even easier because you don't need to worry about the rest of the planning picture. But it does have to be done properly with someone who understands your situation and can advise you accordingly. Don't be scared.
It's good to end on a hopeful note over there. Josh, why don't you tell us a bit more about where people can follow you, see your work, and get in touch? And I'll be sure to share links under the video as well.
Okay, perfect. I mean, I'm on LinkedIn, Facebook, and Twitter, and I don't know what your policy is on phone numbers and emails, but obviously, I guess if anyone wants to get in touch with me directly, happy to share my email and my mobile number, and happy to answer any questions. I think a lot of people always phone up and say, okay, how much does the conversation cost? And I think it's really important to know is that, like you are, we're in the business to help people. And a quick phone call or a coffee or an initial meeting to understand the situation and give a bit of general advice is no cost. I think that's really important to say that. I think I didn't say at the beginning, but you mentioned that you introduced me as an independent financial advisor. So in the UK, the independent is really important. We're not linked to any particular company or bank or anything, and our role is really to be there to help support and advise clients.
That sounds great. I mean, I would say independent is very important here in Israel as well.
I think even more so, I would say.
Valuing, people are really valuing that type of advice and that type of education and guidance and everything like that. Thanks so much for coming on the show. Really appreciate all these insights that you have shared with us. Thanks for listening. Be sure to check out more at blueandwhitefinance.com, and we'll see you next time.